Startups in the UK have access to various tax reliefs that aim to support innovation, investment, and growth. One key scheme is the Seed Enterprise Investment Scheme, or SEIS, which is specifically designed for early-stage companies that are UK-based and meet criteria related to size, trade, and age. The company must not have been trading for more than 3 years and should have gross assets below £350,000. Certain trades, like banking or property development, are excluded. Investors also need to meet conditions, such as subscribing for new shares in cash, holding them for at least 3 years, and not owning more than 30% of the company. Benefits include income tax relief of up to 50% on investments up to £200,000 per tax year, exemptions from capital gains tax on SEIS shares held for over 3 years, and potential loss relief if the company fails. Companies often seek advanced assurance from HMRC to confirm eligibility before proceeding. Another important scheme is the Enterprise Investment Scheme, or ICE, which supports slightly larger companies but still focuses on UK-based firms involved in qualifying trades. The eligibility rules here include limits on gross assets, company size, and age, with funds raised subject to certain caps and timeframes. This scheme also offers tax incentives to investors, encouraging more substantial investment beyond the seed stage, helping startups scale their operations effectively. To qualify for SEIS tax relief, investors need to be individuals who buy new shares with cash, hold them for at least 3 years, and not be employees, directors, or hold more than 30% of the company's shares or voting rights. Investors can benefit from income tax relief of up to 30% on investments up to £1 million per year, with a higher limit if invested in knowledge-intensive companies. There are also capital gains tax deferrals and exemptions available for gains reinvested in or earned from ICE shares held for over 3 years. If the company fails, investors may offset losses against income or capital gains. It's advisable for startups to seek advanced assurance from HMRC to confirm eligibility for ICE. Additionally, companies conducting qualifying research and development activities can access R&D tax relief. This applies to firms advancing science or technology through systematic work led by skilled professionals. Eligible expenses include staff salaries, NICs, certain subcontracted R&D, consumables, software, and utilities directly used in R&D. There are 2 main schemes, RTEC, which gives larger companies a 20% tax credit on qualifying expenditure, and IRIS, for smaller companies with fewer than 500 staff and particular turnover or balance sheet limits, offering a 14.5% credit that can be paid in cash even if the company has no tax liability. Patent Box tax relief lowers corporation tax to 10% on profits from patented innovations if the company owns or licenses patents and actively exploits them. The annual investment allowance provides 100% tax relief on qualifying capital assets, up to £1 million, offsetting expenditure against taxable profits. Overall, these incentives offer substantial benefits to both startups and their investors, but it's important for companies to follow the correct HMRC procedures to register and claim the applicable reliefs. To sum up, it's important to understand how these tax reliefs work together to support startup growth and investor confidence. The reliefs are designed to encourage individuals to invest in new businesses by offering tax benefits, provided certain conditions like holding shares for a minimum period are met. This creates a strong incentive for long-term investment while helping startups access the funding they need to innovate and expand. By taking advantage of these schemes, both startups and investors can benefit from substantial financial advantages.